Morning, everybody, and sorry for that little minor technical glitch as you heard us discussing things. So just to welcome everybody on behalf of myself and Graham to our In the Alphabet Soup with Love, L-U-V, and the W part will become apparent later on. So this morning we're going to hear from Bernard, Helen, Dan and myself. And last week, when we had our Investment Advisory Board meeting, we discussed the world in the context of the economic outlook, the market outlook, and the outlook for the virus. So I know when Bernard, Helen, and Dan speak, it'll be in that sort of context. But I might just start off with a few opening remarks or observations. For those of you who may already be clients, we had shifted. No, sorry. This is the danger of operating live broadcasts. We had shifted our fixed income exposure from US Treasuries into Chinese Treasuries. And I suppose seeing no value in G7 treasuries or G7 bonds, and I suppose subsequent events in terms of printing of money and opening deficits adds further justification that. Another observation I had coming into the year was that the outperformance of US over EFI, which is effectively the rest of the world, had gone on for long enough. The narrowness of the US market and the valuation of the US market, it was can hear you, Dan, sorry, it can perhaps time for that outperformance to...
I'll tell you what, they can carry on, I'll sort it out.
Yeah, sorry, Dan.
If not, I'll ring you back, okay?
So I'll carry on, sorry about that. Since the crisis, that outperformance of America has only increased, despite the fact that one could argue that one of the reasons for American outperformance was the scale of buybacks, which may well be not be a feature of the future landscape. The final two little points to make is that a lot of the policies that the authorities are putting in place now, whether we call it MMT, or as Helen has talked about many times before, about price targeting as opposed to targeting an inflation number, have been discussed and are in the background, and many of the authorities, the central banks, were looking for a reason to put those into place, which is perhaps the reason that they have now. And the final point is just interesting to bear in mind that a lot of us will be used to the Maastricht criteria, showing our age here in terms of budget deficit of the order of 2 to 3%. And that was what we were conditioned to. America has been running a deficit at 5% for the last couple of years, but we got quite relaxed with that. But there was shock and horror when in 08-09, America was running a deficit of 9%. And after this crisis, we're running now with deficits between 15, 17, 18%. So we have entered a very different world in terms of what we believe is acceptable in terms of the scale of deficits. So with that, I'll ask Helen to say a few words. We originally had Dan first, but we'll try and get Dan back on the line. So we'll have Helen say her views of how she sees things, and then Bernard. And sorry, one final point. We will, of course, be taking, we'll try and take questions at the end. But if anybody has questions during the course of it, they can type them into using the Q&A button on the bottom of your screen, and I'll be monitoring those, and I'll put them to Helen, Bernard, or Dan. Thank you.
Great. Well, thank you very much, Ronan. It's a delight to be here virtually, even if I can't be there physically. And good to hear everybody here on this call, and what an absolutely fascinating time and an important time, both for us as people, but of course from an investment perspective, which is what we're here to look at today. So I'm going to, talk for up to 10 minutes or so, and we're going to separate it out as Ronan suggested there, which is there's three things going on, which is number one, the health crisis, number two, the economic crisis, and three, a financial markets crisis. And how do those interact, and what is driving what? So here's my thoughts on all of this. Now, starting with the virus, we're not epidemiologists. We don't claim to know anything about what is happening scientifically, and there's an awful lot of experts out there who are offering their opinion on that. But what we do know, what we can know from all of this, is that people have been deliberately shocked and frightened into staying apart from one another. And that was going on even before governments put their lockdowns into play. And we think that is going to have a significant impact on consumers, whatever happens to the virus. So the way that we're looking at this is we're looking at something called the velocity of people. And for the economists amongst you, there's a well-known concept of the velocity of money, which of course the financial crisis that dropped. The system was, there was no trust between banks, so the money couldn't move around, and that was why we got a huge deflationary shock. But the velocity of people is the rate at which people interact with each other physically in our economies. And that, of course, has dropped massively on some measures. When you look at traffic statistics or bus journeys, everything like that, we're talking 90 to 95% fall in that velocity of people. But there's one indicator that we've been looking at that Oxford University put together, where they looked at mobile phone movements, and it was already in the UK, it was already down a good 70% even before our official lockdown was announced on the 23rd of March. So on the day after the lockdown, people's radius around their houses, it fell another 26%, but it was already very low. And that's what we want to get across here is that there's a huge amount of fear, and fear casts a long shadow. So that will impact on consumer behavior for a long time to come. Not to mention that these social distancing measures are going to be implemented by governments even when things reopen, and that will continue to be a sign to everybody that that the virus is still something to fear, is still something to be afraid of, and will be until, of course, we get to a vaccine or herd immunity or whatever you want to call it. Any kind of solution is at least a year or so away. So that's the virus and its impact on the velocity of people. But that's then a significant shift to the economy and to the potential growth that we might see. Now, there's a lot of talk, and this is called the alphabet soup. Is an L, a U, or a V? What shape are we going to have? Now, there's a lot of talk about the V. We've seen a rebound, obviously, in stock markets. We think people haven't fully begun to appreciate just how significant this economic hit is. So we are actually looking for a U, and that the U will be a drop, and it will sit along the bottom with very, very low growth for several years before we can even come back up again. And that's because of this velocity of people shock. Now, I don't want to get too bogged down in the economics of it all, but effectively the shock hits demand, which means we're not consuming as much. That then hits supply. There's an oversupply of goods. You've already seen that now with there are ships docking from China in Europe that left before their lockdowns at the beginning of January. They're docked in Rotterdam and they haven't got anywhere to go. Actually, it's quite lucky there was no deal Brexit planning, because I saw a guy who runs the port of Zeebrugge talking about, well, we know what to do with all these ships because, we already had contingency plans for the no deal Brexit. So then you get this supply overhang, and then factories producing things have to cut back. So you get a supply shock. And then that means those people are out of work, their consumption falls, demand falls, and you just end up in this constant destruction of potential growth of the economy, because the demand shock and supply shock interact and the dominoes are falling, as I say, whatever happens to the virus. And that's why we're having a huge destruction of economic capital. And the potential growth rates for economies were much lower for many years to come. Added into that, something Ronan hinted at, which is the government's response to all of this. Yes, of course, they're trying to put back in the huge amount of GDP that's dropped out. And, we're talking, we've just seen some GDP numbers there from Spain, France, the US, 4, 5, 6% falls in GDP. Already that's just not even including that's Q1, so not the whole of the lockdown period, much worse than the financial crisis era. Governments are trying to put that back in, but their dollar isn't as productive necessarily as the dollar that's dropped out. So, you know, how long can that last? And, you know, huge amount of money that's being pumped in. Now, that's the economy then. So we're saying huge shock, hard to stop this demand supply shock, roller coaster of dominoes that are falling and the economy potential falls. But what about financial markets, which of course have seen a huge rebound from the lows thanks to the huge interventions by governments now and by central banks. Of course, I like to look at the Fed because I think they are the most important player in all of this. Because actually, if you look at the fiscal policy side, a lot has been announced, but it isn't actually getting through necessarily to business, which the statistics in the UK today about something like 1 in 3 British businesses have applied for some kind of government support, but only 1 in 5 have received anything at all. And 1 in 3 British workers is now on the furlough scheme, where the government pay 80% of their salary. Now, that's sort of, you know, trying to stop this turning into a depression. But the Fed's intervention is very important for the price of financial markets, because we know that central banks can distort the price. That's actually what they want to do. You know, the Fed have rolled out the 2008-9 playbook, and they've done it all in about 3 weeks. You know, it took them 2 or 3 years last time. They've done it all in 2 or 3 weeks. The most significant intervention they've done to date is on the price of credit, because they came and said, you know, not only would they buy ETFs of fixed income investment grade bonds, but they would look at buying high yield bonds. And that was just announced just before Easter. And I think that is the key intervention they've made, because what that's trying to say is, okay, we know some businesses might default, or at least their credit will be impaired, but we are here to kind of just stop it completely disappearing and turning into a financial markets dominoes of a financial markets crisis. However, this is kind of where the problem comes when you start to talk about big amounts and big interventions. At what point is the Fed, is it keeping markets open, or is it keeping markets up? Now, at the moment, of course, it's having the impact of keeping things up. There's still a lot of optimism out there, and you know, I love the optimism. That's wonderful, and I think you know, history has taught us that humanity survives because of optimism. So optimism is a good and natural quality, but it can't get away from the reality. Although the Fed might be trying to kind of stabilize things to prevent it getting a lot worse in financial market terms, they cannot ignore the reality that some businesses cannot and should not survive a huge change in the way we all live and work, because this is going to have huge structural implications. Sorry, I'm just looking at my time, and I think I'm getting towards the end of my little slot here. There's a lot to take in and an awful lot of things that you'll hear. But to summarize, the virus's impact is that it will affect the velocity of people. That being impaired is going to reduce the potential economic output of GDP for economies globally. So a U shape for this recession. But financial markets, for at least a short period, can be distorted away from that reality. But ultimately, what we see happening is that reality will bite. You cannot escape the economic impact of all of this. And that is going to mean that, and certainly what we're looking at is, we would see stock markets falling further over the next 12 to 18 months. And we still think, you know, government bonds will be purchased in huge amounts because of the massive amounts of monetary financing that inevitably is where we're going to get to. And we might want to think about, as Ronan suggested, what does that mean, where the government has now got a huge stake in all of our economies, and how will they end up paying for that, and how will they get a more productive economy in the future? That's the big picture question. So that's how we see it here at Team Blonde Money, but I know we have other wonderful members of our advisory board, and they can give you their thoughts as well.
Thank you, Ellen. We'll come back to you. Dan, are you with us?
The eagle has landed, yeah.
Sorry. Okay, Dan, as we sort of spoke about earlier, and so your take, and obviously we're focusing in on, if you like, three paths: the virus, the path, the economic path, and kind of separately the impact of the market.
Okay. Well, I think the most striking thing is the fact that, particularly, say, if you concentrate on the US market, it seems to essentially be ignoring the economic data. And just looking at that first, I think the broad consensus hasn't really changed that much, in that people generally envisage a fall in Q1 and a much steeper fall in Q2. And as Helen was alluding to there, we've already seen some data from Q1. Today, the Eurozone down 3.5% or something. The United States, actually, they annualized the data, so the fall in the States was only 1.3% in the quarter. So annualized about 4% or so. So first quarter fall, and people are looking, say, for the United States, something like a 9 or 10% fall in Q2, which would be like 40% annualized, say. But then everyone is, generally speaking, everyone, the consensus is looking for a bounce back in Q3 and Q4, and quite strong bounce backs. I mean, the IMF got a lot of coverage when it was talking about, this is like the Great Depression, but that's very misleading, because yes, the fall in Q2 is going to be enormous, but the Great Depression lasted 43 months. So the IMF think that this is over at the end of Q2. So I'm not sure that will be the case. I suspect myself that we'll have a kind of possibly a rolling kind of W thing, where we could get a bounce in Q3 from very low levels, but then if the thing reemerges again, we'll get a fall back. And of course, a lot of the hospitality sector, I don't think will be reviving at all in Q3 or even Q4. So I would say more like the risk is a kind of like as I said, rolling W's rather than a V or a U. The second thing I think I would emphasize, and Helen has alluded to it as well, is I think markets are looking at two things in the States, particularly the course of the virus and the Fed. And it's a strange thing that sometimes it's hard to look at the rational reason why liquidity is deemed to be so important for the equity markets. But nonetheless, that seems to be the case, that markets there have a phenomenal belief that the Fed's balance sheet and the liquidity it is providing is so important for markets. So if you think about 2018, for example, towards the end of that year, the December, you got a big fall in markets. Why? Because the Fed had tightened monetary policy, was running down its balance sheet, and had signaled further tightening. You get a reversal of the Fed's policy in early 19, and of course that prompts a huge rally again. And what I think is astonishing is the extent of the Fed's intervention in this situation. I mean, we're used to them buying corporate bonds, government bonds, which of course they're upping. But what's extraordinary is the assets they're now buying. They're buying corporate paper, they're buying corporate bonds, even extraordinarily enough, corporate bond ETFs. I mean, I think that's extraordinary. And also this loan facility that the government is providing for small businesses, the Fed will buy 95% of those loans off banks. So the Fed's balance sheet has gone from 4.2 billion to about 6.7 billion. That is that's about 55% increase. So I think that is one of the main reasons why the US market has recovered to the extent it has. I think the contrast between that and, say, the ECB is quite striking. The ECB is constrained in a lot of ways. It has announced a pandemic purchase program, PEP, 750 billion this year, but it's already spent 100 billion of that, so that's going to run out in October. So they may well increase that, of course, but they are constrained in a way that the Fed isn't. That's partly why I think US markets have outperformed so much. And I think the other reason is purely our old pals, the FANGs, because people are looking, they're not all of them have huge strong balance sheets. I don't think Netflix does, but a lot of them do, and you see the results from the likes of Microsoft last night. They can weather, the market believes they can weather this, and consequently, you know, they're the blue chip stocks of this era, and that's where they're being bought. Where I think there is maybe markets are a bit complacent is in terms of the credit losses that are going to emerge. We're already seeing a lot of the banks. I mean, the top 5 banks in the States announced 25 billion in provisioning for bad debts. So SocGen, I think, today. So I think the banking sector will be a lot worse. And I know a lot of the banks have, for a long time, European banks have been trading very poorly, but I think that's for a reason. They have a lot of legacy issues, and I wonder if people are underestimating the need for recapitalizations of banks actually in Europe. The other thing Helen has alluded to as well is of course that the deficits, and again, if you compare them, it's quite striking. You know, the IMF have put the American deficit this year at 15% of GDP, which may well be too low. And they've put the Eurozone deficit at 7% of GDP. And we've already seen the difficulties the EU have had to put together some kind of broad pan-European response to this. So it's just exposing the structural flaws in the Eurozone. So to me, it's another reason why the United States has outperformed and possibly will continue to outperform. And of course, I was making a point recently in a blog I do about that this isn't, so far, it isn't being paid for by helicopters. It's been paid for by taxpayers. And I think there's a misnomer about when people see money being paid out to people, that's been transferred from taxpayers, albeit taxpayers from the future. Now, that may change, but you know, and the United States has monetary sovereignty that can effectively monetize some of the fiscal spend. Europe can't really do that the way it's constructed because European countries don't have monetary sovereignty. They can't print euros the way the States or the UK could, or Japan indeed, or China. So I think you know, that's worth bearing in mind, that you know, that the fiscal deficits will be very, very large. So probably there's probably the deflationary impact will keep downward pressure on bond yields, but at some point you'd think that sheer scale of the issuance that will be required will push them higher. I'll stop there. Okay, Rona?
Thank you, Dan. Thank you, Dan. A number of questions, but I'll let Bernard speak for 10 minutes or so, and then we might address some of the questions that are coming in, or pick up on some of the points that have already been made by Helen and Dan.
Okay, good morning, everybody. Yeah, so I'll do the same. I'll talk briefly about the virus path, the economy path, and the market path in that order. Just to give you an idea, I'd be relatively sanguine on the virus path, even though I'm not a medic either. I'd be relatively sanguine on the economy. I'm not like saying everything is going to just get back to normal quickly, but I'd be relatively sanguine on what the market is discounting. The economy, you know, can probably perform too. On markets, equity markets, notwithstanding being sanguine on both of those things, I'd still be cautious, and it's more cautious over the medium term than over the shorter term. So just to talk about the sanguine view on the virus very briefly. It's very important, but it's not everything, because clearly there's you can have an exponential damage to the health of the economy, and you can have an exponential acceleration in the virus, and you're trading the two things off when you're managing the total situation. That's what governments have to do. I saw yesterday in New York State, the first antibody survey. In other words, the first survey to see the prevalence of this thing across the population, not just who has it and who's recovered and who's sick, but who's had it, what percentage. And they reckon 15% of the population there have had it. So, that's quite significant, but it's not your herd immunity, but it's more than, it's quite a significant part of the population they reckon already have had this. And you can use other figures, and you can estimate, etc. The death rate is probably running at 1%. These guys would be saying, okay, there's assumptions in there. That's a very serious disease. It's not as serious as sometimes you can see when you see higher death rates, but when you see that it's spread more widely across the population, get it down to this. If that's going to be rising towards 50 or 60, you can still see it's a very serious problem, but it's not going to dominate the economy totally at that. So if authorities, and they have to be doing it, otherwise they're failing, get their ICU capacity up to cope with any second waves, etc., get their testing and tracing capacity up, and keep the virus contained. There's a way through this with the virus, I think, even without seeking perfection and eradication of the virus. Beyond that, we're reading every day about medicines and vaccines, etc. That would be a game changer, but let's make no assumptions there. So I'd be relatively sanguine and optimistic on the virus, but I know nothing that we're not all seeing every day about that. I have no expertise whatsoever in that area. On the economy, so let's assume that the virus takes a reasonably, the better path and allows economies to be reopened. The next risk is that the economies refuse to reopen because of what's going on with consumer confidence and all kinds of other things. On that one, I'd be sanguine. I think human propensity to forget over a period of time and to adapt shouldn't be underestimated. I think you look at Asia, where this isn't as new to Asia, and they've been dealing with this type of thing on various scales for quite a while, and it didn't shock them as much, and they have ways through it. And it's never, when their experiences they've had of it, it never changed anything permanently. Now, there will be for sure changes around the edges that will be permanent and probably positive everywhere coming from this. But as to whether they would be the type that would actually cause an economy to refuse to reflate its demand, aggregate demand again, I'd have doubts, and I'd be more optimistic on that score. So you can have some changes that will be green friendly, and maybe they'll be good, that type of thing, in the way we live our lives, etc. But one form of demand comes in to replace another form that goes away over time. Nothing very quickly. Whether you call that U or V or anything, I don't know. But I think that it'll happen if the virus, if we can get the virus moving in the right direction, that this will happen at a rate that won't be too deflationary and whatever. And to the extent that it doesn't, of course, the stimulus just stays there until it does, or that's what it's trying to do, or you get more of it. So this stimulus is open-ended too. So sanguine on the virus, sanguine relatively on the economy, then on to markets. They've been, as Dan and Helen have said, they've been surprisingly resilient. I mean, the US equity market is only off 15%. And, a balanced portfolio of equities is off 18%. And for a shock the scale of this, that's surprisingly, modest in my view. We've had an 11-year upcycle coming into this. So coming into this year, before we even knew anything about a virus risk, there were grounds to be, cautious around equities in terms of, the potential for things not to be quite right for the future, around the fundamental drivers of equities, which would be interest rates and earnings for the longer term. So it's clear that, that it's the huge, unprecedentedly huge and unprecedentedly fast scale of the stimulus that's been put in here is what's supporting equity markets. And you can see how, from the point of view of an investor, we've had so many buy the dips opportunities that were right over 11 years that now you've got this, the ultimate test that should finish everything and drive us down 50%, and yet it hasn't happened. So you can leave investors with the idea that equities are in fact indestructible. There's nothing you can do to make them go down, because no matter what happens, and what could be worse than this? And you can see that mentality can technically be very strong in the market near term. So this is about the course of the virus and reopening of the economy in the near term. And I could see that, equity markets could actually recover their highs and even go beyond them over the near term if this takes the more, let's say, the more optimistic path in terms of the virus and the economy, or even, but still a very reasonable path. But beyond that, and if that doesn't happen, there's various things. If the virus is more problematic and we get another wave, then there's protection on the downside, I think, from this stimulus and the willingness to put whatever stimulus is required in to keep economies and markets. I don't think they're trying to hold markets for the sake of holding markets, but they hold the economies, and in the process, they hold markets. You can't do one without the other. And the stimulus is justified for as long as it's required, for as long as the economy is threatened. But beyond that near term, I would still have caution, have reservations about equities. Not to the extent I say sell everything and get out, but I'm in no way, I'm not finding them attractive at the moment. And if they go higher from here on better news, which they could, I'd find them less attractive. So why? Interest rates and earnings are the long-term drivers of equity markets. It's a question of when and over what time horizon any problems on those could surface. Earnings coming into this year, before we even knew anything about this virus, were already underground because of the trade, etc. They disappeared, earnings growth. And there were grounds for structural worries about where the structural level of earnings growth is evolving to in a very, very low return, in a required return environment anyway. In other words, for years and years, we've come into every year looking for this magical 10% earnings growth in markets. It gets shaved back. But what if that's really 5% or less now, and we just don't know it? And that's before we even talk about the virus. Now, the virus has driven earnings, the visibility on earnings further on the ground. So you could say, forget about 2020. And one of our partners in ESN's looked at it and come to the conclusion, earnings in 2021 could be 17% lower than 2019. So already earnings are cloudy, structurally cloudy in terms of what you can expect from earnings growth in this environment we've been in for a long time. And now you're knocking a base off that. So I'd have reservations about earnings over the medium term in the market, and the way this aggravates that to a lower level, where those reservations would still be structurally there. And the other big thing is interest rates. And the big influencer of that is inflation. We can have all of this stimulus, all of it, because there is no inflation, and there hasn't been for 30 years. If inflation came back as the thing that it did in the distant past, to tell you can't keep doing this because the real world is there's a shortage and the scarcity exists in economies, well then this flexibility in policy isn't there anymore. And then the very low interest rates that support the market become suspect bonds, suffer, etc. So you'd be very brave now to call inflation after not disappointing any inflation pessimists for 30 years. But you can never ignore the risk that actually that big wheel stops turning in the positive direction, and that this might aggravate it in terms of stimulus, the size of the stimulus, and the politics around withdrawing the stimulus if the economy actually recovers over a reasonable period of time, with the virus having allowed that. Then how do you get this stimulus out of the economy? The trend had been kind of, I think, politics of the left before we had this, and this magic money tree, this MMT, how are we effectively getting that by default, even though nobody decided, and how do you get out of that? And that is quite worrying if you're going into that environment politically, and in terms of the way central banks will be compromised in terms of their independence. So I'd have worries medium term about inflation, or I certainly can see how that could change the game if it was there. It certainly has to be watched. And as Helen and Dan have mentioned, the other tail risk from this are the sovereign risks that come out of it. To take Italy, it's very hard to imagine that that Italy doesn't come up against some wall in terms of where you can talk about this all being down to the virus, but Italy was fiscally on the wrong side of things anyway. Where did one start and the other stop? Italy would be happy to blame it all on the virus and run deficits of any size into the future. The EU politics around that, it's all to be played out, and I couldn't be too optimistic in terms of the way that will develop for the unity within the EU. So short term, I could see equity markets, if things go reasonably well for the virus and the economy, actually going higher. And markets always surprise us. You can get new highs at the, out of things like this, because it's so short and sharp that people can say is equities are indestructible. So you might as well buy them now rather than buy them higher in 2 years' time, etc. But that can't be forever the real world, that you can just keep pumping money in to solve a problem. And the only test ultimately will be the inflation test. And it's a question of where that is. But in the meantime, we can have sovereign risk and politics and earnings fall out from this too. And the earnings problem might have been there anyway in terms of expectations for earnings in markets being structurally still too high. So near term, the virus driven, probably allowing the economy and the market to be stable and perform and being protected on the downside by stimulus and more if necessary. But medium term, I still would have reservations on equities. I'm not saying selling them, but I'd say that bit more cash to hold to get us through, a bear market. Because if we come out of this and we say the cycle ended after 11 years, so surely when a cycle ends after 11 years, all cycles before, if we had the nerve to buy them at what turned out to be the lows, way lower than these lows, you had years, the bull market all ahead of you to make the money. But if this is all over, over so quickly, and the equity markets are back up, there's no point in saying equities, you buy them because the cycle is over and the new one starts. Not unless they've fallen enough to make that a good decision. So that'd be my view. Cautious on the markets, but more optimistic, I'd say, relatively on the other things driving them.
Thank you, Bernard. We have a number of questions coming in, so if anybody has any questions, if they can type them in. There was one question which was to Helen's point, but I think sort of Bernard answered it, and you can see there's always along the lines of that if the markets are going to fall sort of further, should we be selling the rally as opposed to being the idea that we're used to buying the dip. So we might come to that in a second. And there's another question in relation to gold. But I'd like to sort of put one question to everybody for just for a moment. It does appear that the authorities, the governments collectively, and I think there's a greater fusion now between the central banks and the governments. So the independence of central banks, I think, which we've been used to, is a little bit of a thing in the past, is that losses are going to get socialized. And Bernard made a comment last week that I think it was Sinn Féin had said, but whether it was Sinn Féin that said it or whether it was politicians or oppositions on the other side, the ordinary people of Ireland are not going to pay for this. And I think it's a very good phrase, because I think the politicians are going to be in great difficulty getting the ordinary people to pay for it, with raising taxes and or cutting services, which means persistently higher deficits. And those deficits, again, whether it's QE, MMT, are going to be funded at zero interest rates, because whatever else happens, we are going to manage the yield curve like the Japanese have done. Now, in a way, this is a fantastic scenario. If we can run these 15% deficits, build as many hospitals and schools, and have as many nurses and police as we want, and no downside in terms of significantly higher inflation. So to me, it seems difficult to see that we can run these big deficits. It seems it's difficult, and I believe that it may be more difficult to exit the support measures than it will be to exit the lockdowns. So just, I wouldn't mind sort of trying it, how and when do we exit from these enormous deficits? And as I say, we used to be used to 3, 4, 5, now we're up into 15 plus. without it causing an inflationary change in the inflationary cycle?
Well, I would kind of slightly disagree with you in the sense that a lot of the falls in a lot of the deficits are to do with the economic cycle. In other words, they naturally occur if the economy contracts massively, and if the economy as people expect, which may be wrong, but the consensus is a fairly decent bounce back in 2021. If that happens, then deficits will come back down again. And I'm afraid I think Mary Lou is wrong in the sense that I think we are going to socialize it, because in the Eurozone, what we have is a situation where, yes, the ECB is buying a chunk of bonds. So what does that mean? It means that the interest rate paid on, say, a third of them that the ECB can buy goes to the central bank, which is profit for the central bank, and then comes back to the government. So yes, you're saving interest there, but what happens when the bonds are redeemed? And the answer is you've got to issue new bonds to pay for the redemption. So I do think that we've got QE forever. I think that's pretty obvious, but that's not the same thing as Bernard talked about the magic money tree. So I think we will have deficits will come down. I do think that fiscal policy will not, that certainly the likes of Germany will not be happy running 4 or 5% deficits into the medium term. I don't think anything will change there. So I do think that that governments are pledging, say the Irish government saying they won't raise taxes, but I do think that there will be some impact in terms of deficits may be slightly higher, and you can run higher deficits if interest rates are lower, of course. I think we were moving in that direction anyway before this. But I don't think myself that we will be in a permanent position where we're running 5 to 10% deficits in Ireland. I just don't think that's going to happen.
No, I don't think so either, Dan. I think it's the risk is the tail. You know, the bit at the end that should have been taken out if we can get the economies not requiring the deficits again, but the bit that doesn't get taken out. So therefore, that bit of fiscal deterioration in terms of fiscal rectitude that you can't, define as, was that due to the virus or was that something else? Because let's face it, the populist type economics that wants to run deficits isn't going to take the scalpel out in differentiating between how much of this is warranted by what we've been through and is gone, and how much of it is still there. So it's at the edge, it's the tail at the end that I would worry about. So you take Italy, it was always going to be a problem to keep Italy within the ECB's deficit limit. It's going to be all the harder now.
Yeah, and I mean, I would pick up on the politics of all of this, because I think it was Dan was just there saying, we were headed in that direction anyway in terms of running higher deficits because we're at low interest rates, and it's always very tempting. I mean, the UK government was already throwing off austerity, but that's fair enough because the deficit had come back down again, and it's a very interesting point about the politics of this and about who's going to pay for it. And that we're going to hear more of the sort of things that Mary Lou has been saying. I think we'll hear that sort of sentiment all over the world. Very long term, who pays for this? Well, it's our children, whether it's taxes or inflation, or a mixture of both. I wouldn't be surprised though that when it comes to election time in the years to come, the taxes and the tax system shifts to try and signal who should be bearing the burden. And again, this was already happening anyway in terms of talks about a wealth tax. Here in the UK, there's been very preliminary talk of a health tax, and you can imagine that sort of thing might gather ground. And I would think, the big multinational organizations, Google and the rest of them, there's already been, trying to get hold of more taxation from those kind of companies. So this sort of thing, we might see some of that global cooperation to try and get more of that taxes in. But But it's, I think, really big picture. You know, are we all Japan now? And there's 2 points on that. Number one, yes, we all talk about Japan as a disaster, but of course they do have a relatively decent standard of life, despite their dreadful demographics and yield curve control and monetization, which they've been doing for years, and deflation. But equally, the structure of something like the UK or the US economy is much more prone to inflation anyway. Certainly in the UK, that, you know, anywhere that's more of an open economy can have a propensity towards more inflation. So I think, you know, the really big question is, yes, we can all survive. We can survive with bigger deficits for countries that got their act together and sorted themselves out a bit, which a number of us have. Interest rates to be zero, QE forever, so we can. We need some inflation to inflate away the debt. So the really big problem only comes if you have that real runaway inflation and that it gets into some sort of cycle with it. That may well be something to be a concern long term, and how, you know, politicians might deal with that. But it's something for a lot further down the line. But it will be something that, yes, so-called populists or even maybe more left-wing type parties will reap political capital from talking about, well, who should pay for the cost of these things. So we will hear more of that sort of thing.
Roland?
Yes.
Could I just give a simple example what I mean about for Ireland. Like, so the Irish, the average interest rate on Irish debt is 2%. So if the economy in nominal GDP grew at, say, 5%, then you could run a 3% deficit every year without increasing your debt ratio. So yes, we probably will be in a situation where where deficits will be the norm. And I personally think a lot of the Irish stuff was about our debt position that is ludicrous. And we could have had much higher spending anyway. So yes, I would say we are going to move to positions where deficits are the norm, but where I don't think we'll be kind of, you know, 5, 10, 15% deficits. That's all would be my view.
Okay, now just I see we've got a number of questions coming in, and some of these questions, if we don't get to answer them live, kind of wanted it on air, we'll come back and answer them separately. But a couple of quick ones. Helen, there was one there in terms of your U. There was a question: how long is the bottom? And it was 3, 5, or 10. Now, obviously, very difficult, but just you did sort of say, just to give us a sense of how long you think, if it is the U, that bottom may be.
I think we're looking between 5 and 10 years. I mean, I do think this is a serious, long-term, slow return to any kind of decent growth levels. And part of the reason for that is the lockdowns, the global shutdowns. You know, global trade is shutting down, travel, all the rest of it. You know, clearly some of that's going to be eased, but there's going to be a lot of grit in the system. So supply chains will be a lot tougher, and there'll be a lot less travel. Businesses are changing how they work. People are doing virtual meetings like this, etc., etc. So we think, yes, this hit is so big, and it's having the fear cast such a long shadow. We're going to change the way we live and work. Yes, this is a 5 to 10 year time horizon.
Okay, thank you. Does corporate America, as is often the case, not come out of this much stronger? And the example is giving in terms of much more M&As that we're already seeing, Amazon and Deliveroo, for example. So, Bernard, do you think this has positives for corporate America?
Well, corporates have to adapt to situations, and there'll be victims in this. There'll be companies going under. Probably, you know, more in the very vulnerable industries like airlines would be a classic example. Corporates that survive and with less competition going forward, or take out the competition, come out stronger. You know, even in the same industry. Yeah, I mean, I wouldn't say they come out stronger or weaker. The jungle just continues, and companies adapt. Some don't survive, some do, and those that survive are, you know, can probably be stronger going forward in some industries that are shaken out.
There's a question as well in terms of the social distancing. Do you think that's going to differ? Do you think the question relates to vary by age group? Now, I've sort of said to many people, you can have comments in relation to that are not to be held in polite company, so to speak. But it is something that increasingly comes up as to maybe the vulnerable should be isolated and everybody else should get back to normal. Okay, and even here in Ireland, I think it would be great disappointment if the lockdown is not eased next week. I suspect it's the same in the UK. So the question relates to the social distancing and the velocity of people. Does that differ by age group? If anybody has any comment on that. And then related to that, there are a lot of questions that again, if there is a vaccine or to the virus, to what extent does that change the nature of what we're sort of talking about in terms of the slowness of the recovery?
I'll just jump in for a second there and say that, yeah, demographics, of course, can have an impact. I've been looking at some survey data post-SARS in Asia, and attitudes towards going out and what would make people concerned about travel or going to a restaurant, things like that. And of course, yes, there does seem to be a sense that the people who are older may be more concerned than people in their 20s. I think, though, that you can slice or dice that sort of thing various ways. You know, is it by gender? Is it by jobs type? Is it by rural versus urban dwellers? I mean, yes, there will be slightly different attitudes. We don't worry so much about that. We're thinking more about, look, if you took the index as 100 before we began, and within 100 people, some of them will be mad to binge on freedom, you know, and, you know, I personally would love to go back to the pub, obviously, and I wish we were doing this, we could have a drink after. But as long as there are some people who are going to be more frightened, worried, concerned, then that will have a drag on their kind of behavior. Some survey data is already being done in the US on this. It usually comes in around about 25% of people think, yeah, I'm very happy to go back to doing what I was doing. But around 50 to 75% of people are rethinking, well, I'd rather wait 3 or 4 months before I went back to a shop, or I won't be booking a holiday for a year, etc., etc. Sorry, you had another part to your question, Ronan.
Well, just the extent that we're getting questions in terms of, like, obviously news or potentially news yesterday about viruses. Okay.
Oh,
does
yeah.
that significantly change?
No, not in terms of how I perceive human nature. You know, if you frighten people enough that you told them to literally stay in their house, it kind of doesn't really, you know, at what point do you then trust, oh yeah, it's fine now, we're all vaccinated. And in any case, it's at least, from what I can hear, 12 to 18 months away. So yes, maybe by then it might have a slightly more optimistic output, but the economy, I'm expecting to have lost a lot of ground by then anyway.
One aspect of it, Ronan, is there's different, you know, aspects to that question you asked there, but one aspect is the extent to which, you know, vulnerable groups, relatively more vulnerable groups, are told to do things or told they can't do this. My own view is that the more time goes by, and if we're lucky enough to see that there's a control of the virus, even though it's not gone and it remains a significant risk, and economies reopen into that situation, but the authorities realizing or increasingly confident that their ICU capacity, their tracking, etc., is good enough that they worry less and less about an uncontrollable acceleration. In that scenario, the vulnerable groups get to do what they want. I mean, I don't think the state can tell them to stay at home. Why should they? You take your own risk there, you know, and that's the way it should be. And those that stay at home will demand less in the way they used to, but they'll demand more in other ways. I was looking at a takeaway the other day to be delivered. The cost of it was something else, you know. I could have eaten in the same restaurant with not having to wash the dishes and serve myself.
I'll get somebody to wash them for you, Bernard.
2 months ago. So, like, demand goes away in certain places and comes back in others.
Yeah, but I would also stress though that the market, what the market thinks at the moment, and you saw yesterday what happened with the Gilead thing. So if you read what happened there, that is an antiviral drug which has been around for a long time, and they did a proper test, and what they haven't released the full results, but the impact on people dying was not statistically significant, but people got better, if you like, in 11 days as opposed to 15 days that weren't given the drug. So, that the way the market reacted, you'd think like that's going to be a massive game change. Well, clearly it's not. And as Helen was alluding to, I think it's a long time before we could see a vaccine emerging. But if the market thinks that a vaccine is nearer, that's going. At the moment, the market's just looking at any positive thing, ignoring any negative data that comes out. I mean, you wouldn't have thought that 20 million rise in U.S. Unemployment would be particularly positive, but market just shrugs.
Yeah, there's a couple of questions about gold, so we'll come to that in 1 second. But one which relates to kind of the thing that we've often talked about, Tina, there is no alternative. Okay, so in terms of constructing people's portfolios, as I sort of said earlier, buying euro sovereigns, almost in many instances, you're guaranteed to make a loss at the negative yields. US sovereigns at 50 basis points doesn't seem to be a whole lot of value there. So your traditional 60-40 portfolio with the 40% in the fixed income is a very difficult environment to sort of fill in. And there's a question here that relates to with the massive fiscal deficits going on, does it lead to sovereign defaults and a lot of debt forgiveness? And I suspect that's possibly related to, or we can answer that question in relation to sort of gold. And clearly gold is an asset class that divides opinion like no other. You are a gold bug or you're not. Okay. Bernard, will you take that first then, please? And then.
Yeah, I think it's always right to consider gold for for having a place in a portfolio, and to hold it when you think it's right to hold it. I think it's wrong to consider gold as an asset class to the extent that it might mean, oh, asset class, that means I can have 10% of the portfolio. And I think that's too much for gold. So I consider gold more the status of, a stock, say, in a portfolio. So say if you've got a reasonably aggressive portfolio, maybe 20 stocks, you could have 5% of your portfolio in gold. And I think there's nothing questionable about that. Other times you'd have nothing in gold because a lot of the time gold won't give you a return. Where are we now? I can see the argument for gold now with interest rates structurally so low for years. And now the question is, Mark, because if there is a risk that the economy stay depressed for longer than I'd be hoping, etc., well, that's deflationary environment we're talking there. That's not inflationary because there's nothing to cause the inflation in that environment, and that's an even lower interest rate environment potentially, and that supports gold. And then if you get the inflation coming in before the interest rates pick up, real interest rates are still going lower. So I can actually see the argument for gold at the moment having a place, or precious metals having a place in a portfolio as a hedge against some of the things that are worth hedging against. It'd be silly to call them and to be aggressively calling inflation to pick up or this or that to happen. But it's worth hedging against that more, I'd say, as much or more than ever right now. So I can see a place for gold. Is that your question, Ronan?
Yes, and also in the sense of the other question there was to the extent it will be with the massive issuance of debt, will there be sovereign defaults and debt forgiveness?
Well, you can have this massive, which we're getting, issuance of debt, and back to Dan's argument, structurally, if this is warranted So economies do need it when they need it. It's a question of, can it be taken away when the demand comes back, and therefore you should withdraw the stimulus. But structurally, if you're in an environment where you can do this without getting inflation, as you've been for 30 years, I mean, that's the amazing journey we've been on here. If that's going to continue, it doesn't therefore lead to sovereign defaults. It just is a strange world, which, you know, still has so much capacity to issue debt and create money into. That can't last forever. There is always theoretic bounds to it. If we begin to explore them, then you're into where the rubber hits the road, so to speak, and you get, at the worst end of it, you get the potential for sovereign defaults. Like Argentina, I think, has defaulted again anyway. That's Argentina, but Italy and other countries, and then but the ones that don't default, that aren't going to default, but that are what we call have sovereign control of their currency and all this type of thing, is their debt becomes dodgy at the margin too in that scenario, because they're so you take the US, you're not really talking about a default because they can print their own money. But what is the default? The default is a pickup in inflation that depreciates your money. So, you know, what's the difference? There's no difference in the end. You can lose out by inflation. You know, the Fed will print all the dollars, and that's in that scenario that was ever owed by the government to you. But if you get them back 80% of their value, that's the way you've been defaulted upon, you know. So the pressure comes on the same way, and the guys that are in the weakest position obviously are the ones at default risk. But even if nobody defaults, if the pressure comes on there, you will take hits, you'll make losses in that scenario on sovereign debt, with or without the default.
Okay. I'm just two final comments here, because I'm very conscious of the time. We're kind of to our sort of time limit. Just in looking at the comments that have come in, there's certainly an undertone that human nature adapts, has adapted and may well adapt quicker. And then there's a couple of questions which are, how confident are we that the governments are able to weigh up the health cost versus the economic cost? And at what point and where are we in terms of that pendulum swinging? So again, there's a political thing there, and I think I echoed someone else that personally, I would be very disappointed if some of the restrictions next week are not lifted. So, and at what point do people think the authorities have had a good crisis as opposed that they've gone too far? So it is, you know, can we, to what extent are we confident and comfortable that the governments are able to weigh up that the political, the health cost versus the economic cost?
Well, to use your analogy there, Ronan, on the pendulum, I think clearly the pendulum has swung to the economic cost is too high. So I think we've seen already in a lot of European countries some partial unwinding of the lockdown. And I think in Ireland, it's breaking down anyway. I think it's breaking down anyway in a lot of countries, not dramatically, but certainly there's more people around. But I'm not sure that's really the issue. I think clearly, yes, we can open up some shops and stuff like that. But the question is this. In certain sectors of the economy, companies are continuing to do well. As we saw, as I said earlier, most of the FANGs have done very well out of this. Anyone on the internet side, I was just actually looking at Irish retail sales, just came out. If you take out cars, it was only down 1.9% on the month, which is quite astonishing, I thought. And the reason was that there was a massive double-digit increase in food, pharmaceuticals, electrical, a lot of which is obviously bought on the internet. So, but clearly the big problem will be for a lot of the service sector. And, you know, are we going to see how are airlines going to do, how are bars going to do, how are restaurants going to do, how are hotels going to do? So I think in certain areas, even though we do start easing lockdown, they're going to suffer. But to take your point, I think we're certainly moving towards the view everywhere that the economic cost is now too high. And it's led to some crazy things. I just saw the other day in Ireland, they took over private hospitals, and private hospitals are operating at 33% of their capacity. So there's a huge amount of spare capacity, even in the health sector, which has not been used. So I think all of that will start to change a little bit, because it doesn't make any sense, clearly, to have that situation. And obviously, they were planning for the worst. But whether people have had a good or a bad thing, I think time will tell. I think maybe people won't be as judged. They won't be judged as well over time as people think.
Yeah, you need, you know, like you take our local situation here, as Rona said, May the 5th. You would expect that even if they were going to be relaxed even significantly, that between now and May the 5th, the government don't want us to assume anything is getting better, so that you will be hearing the more negative story until May the 5th, even if they are going to relax. So that's where you don't quite know until you get there, because they want to maximize the extent to which we kill the virus between now and May the 5th. In terms of the leadership, if you take in Ireland as to where it is, the worry is, no, the medics have taken over there, and you need the business economist type in to balance it. That gets there, but if you look at the US mob rule more there, you can actually see the demands, you know, that will lead the politicians. So if the politicians don't have the leadership, and they often don't, you're getting it from the people. Now, whether that's, you know, sometimes that's worrying, because you say this is a mob, but ultimately you need that kind of pressure too. So I think we're going to follow what we see, and I think the US is going to eat them that kind of thing, and some of the other bigger countries in Europe that are probably in a better position are going to lead on it, and then we're just going to follow that, you know. But the leadership comes from somewhere in the end, and there is the risk that if it doesn't come from something other than politicians, that they cover their backsides by you know, referring to the medics all the time and for too long.
Helen, we might leave the last word to you.
Well, I think that yeah, certainly time is going to tell, as Dan said. I mean, here in London, just to give you a flavour, the streets are dead. It's silent. You can hear birds. There's no planes flying. It's almost idyllic, quite frankly, compared to what it's normally like. Having said that, just in the last week, the footfall is going up. There's more traffic on the roads. The sense here is that people will break this, and they are breaking it, and that will sort of lead the government to be able to say, oh, okay, right, we're lifting it now. But I would say, you know, when our government put certain things in, for example, dry cleaners could have stayed open, garden centres could have stayed open, and they didn't. They shut. Even a little grocery shop that I've been using, they shut down. And why is that? Well, it's because their staff didn't feel safe working there for various reasons, like, you know, there's no boards up where they're serving, and they don't want to take cash at the till, and they don't have gloves and all the rest of it. So I guess what I'm trying to say here is that, and we've focused a lot on the virus, but the way that people want to live and work is changing. Here they're talking about running train services deliberately at 25% capacity. You'll have heard about the airlines having to take out the middle seat so that there's social distancing on planes. God knows how you do that. Everything is going to be more physically distant. It's going to be a more painful process and not as much fun to do those leisure things. Even the restaurants in Hong Kong have an area that is, you know, cordoned off, and the waiters and waitresses don't they only come up to you once to give you your food. You know, the whole thing is changing. And so when it comes to about judgment about all of this, that change to our way of life is going to eventually, unfortunately, lead to people losing their jobs. When they lose their jobs, they're going to be angry. There's going to be people doing more saving rather than spending when they see people losing their jobs. A classic recession, of course. Who are they going to blame? Inevitably, they will blame the government. But so far, you know, the verdict is we don't quite yet know where the blame is going to fall. But I think that Boris Johnson's going to feel a lot happier having a good 5 years before he has to face the electorate again, versus, of course, you guys over there where you're still trying to thrash out a government, and then, you know, Trump is obviously the big one, over in the US and how that election is going to go. So we shall see.
Okay, very good. Bernard, thank you. Helen, thank you. Dan, thank you. And thanks everybody for joining in this morning. Any of the questions that we haven't got back to, myself or Graham will get back separately later on today, and we'll have a recording up of the discussion on the website later on. So with that,
Ronan,
yes, Dan.
I just have one quick question. I'm looking at your bookcase behind you. Why have you taken down all your Chelsea annuals?
I'll speak to you later. Thank you, everybody. Thank you, everybody, for joining the meeting.
Take care, everyone. Bye.
Bye.
Everyone, bye-bye.